So QE, which doesn't work, by the way, they printed $10 trillion and the economy was flat to down. It was down sharply in 2000, but it was flat for the 10-year period from 2009 to 2019. So coming out of the global financial crisis in 2009 until COVID, which was 2020, but until COVID, 2019, that 10-year period, 2009 to 2019, average annual growth in GDP was 2.2%, 2.2. During the Reagan administration, 1983, 1986, the U.S. economy grew 16% in real terms. That was over 5% a year for 3 straight years. That's growth. That's what the American economy can do. And even if that's not totally sustainable, you should be able to grow 3.25%, 3.5% on a consistent basis. That's what a developed economy should be able to do. So 2.2% is pathetic. I mean, you can get out the pom-poms if you like, but that's really pathetic growth. That's what we have for 10 years. And my view is that the U.S. economy has been in a depression since 2007. And people say, well, wait a second, Jim, recession is 2 consecutive quarters of declining GDP. And that is the rule of thumb. It can last 3 quarters.
In this interview with Jim Rickards, the discussion revolves around quantitative easing, QE, and its efficacy in stimulating economic growth. Rickards argues that QE, which involves central banks purchasing bonds to inject money into the economy, has not been effective. Despite the massive injection of funds, up to $10 trillion, economic growth has been lackluster, with average annual GDP growth of only 2.2% from 2009 to 2019. He contrasts this with the robust growth experienced during the Reagan administration, indicating that the current growth rate is far below what the American economy is capable of achieving.
Sometimes longer, but they tend to go 6 to 9 months of declining GDP, 2 or 3 quarters. That's the technical definition of a recession, and it is. And so people say, well, depression must be worse than a recession. So if recession is 2 quarters, the depression must be 10 quarters of declining GDP. And we have not had that. But that's not the definition of a depression. A depression doesn't mean continual declines in GDP. It means below trend growth. It means depressed growth. And it was what I was just saying earlier. If growth potential is 3% and you're growing at 2%, that gap between 3% and 2% over time is trillions of dollars of lost growth. So has the economy been growing? Yes. It grew in 2023 and so far in 2024. But it's depressed growth relative to potential, and that's what a depression is. And if you want an example, just look at Japan. I mean, Japan has been in a depression since 1989. Well, really 1990, December 31st, 1989. They rang the New Year's Eve bell, and then boom, the stock market fell out of bed. It declined, I think, 75%. It just got back. By the way, about a month ago, the Nikkei index just got back to where it was in 1989.
Rickards contends that the U.S. economy has been in a depression since 2007, not in the traditional sense of continual GDP decline, but rather in terms of below-trend growth. He draws parallels with Japan's prolonged economic stagnation since 1989 to illustrate his point. Despite occasional periods of growth, the overall trajectory has been one of depressed growth relative to potential.
So, which is about 40,000. So, nice going, guys. It took you 34 years to recover your meltdown. And that's all they've done is recover it. It hasn't gone up much since then. But Japan has had 9 recessions since 1990. 9 technical recessions. Well, you can chart the recessions, but I call it one long depression. It's a 34-year depression. And I would say the U.S. has been in a depression since 2007. So that's 17 years. We got 17 more years to go. But that's why everyone's out of sorts. That's why real incomes are not going up. That's why income distribution is, the rich get richer, as the saying goes, and they do. And everyday Americans are falling behind, and the middle class is getting wiped out. So, but you can still look for a technical recession within that time series. So, but getting to your point, Matt, QE doesn't work. You talked about government spending and deficits. That's correct. That's fiscal policy. So QE is monetary policy. That's what the Fed does. And deficit spending is fiscal policy. And that's what the Congress does. So let me spend a minute on QE. How does QE actually work? Well, everyone says the Fed's printing money and the Fed's printing money. Well, what's your definition of money? I mean, the Fed has 4 definitions of money. So start there. They have M0, M1, M2, M3. Some people think Bitcoin is money. You get to a point pretty quickly where no one really knows what money is. By the way, I have a chapter on that topic in my new book, which is coming out in November. So how does QE actually work? How does the Fed print money, if that's what they do? Well, the way they do it, they buy bonds from Wall Street. They call up the primary dealers. I used to be general counsel, one of the biggest primary dealers. They call up the primary dealers and they say, offer me 10-year notes or offer me 5-year notes. So it's your Goldman Sachs or Citibank, whatever. You quote an offer and the Fed says done. And then the dealer delivers the bonds to the Fed and the Fed pays for it with money that comes out of thin air. So the Fed gives the money to the dealer to buy the bonds, and that money comes out of thin air. That's M0-based money, printed money. The question is, what does the bank do with the money? The bank just sold the bonds to the Fed. They got paid. What do they do with the money? They give it back to the Fed. They give it back to the Fed as a deposit, something called excess reserves. And the Fed pays them interest. It's the same way you get interest on your bank account. The Fed pays interest. It's called interest on excess reserves, IOER. So all the Fed is doing is building up the balance sheet. The asset side is being built up with bonds, or buying bonds. And the liability side is being built up with deposits from the banks, which are liabilities from the Fed's point of view. So you're expanding the balance sheet, but the money's not going anywhere. All the QE money, $10 trillion, never went anywhere. They paid the dealers and the dealers gave it back to the Fed. It was sterilized and never did anything. So was the money printing? Yeah, if you're using M0 to measure, but didn't do anything for the economy. It doesn't stimulate growth. Ben Bernanke was full of it. Jay Powell's a little more honest. Janet Yellen, she's kind of a affirmative action dunce. They didn't understand any of it, and it definitely did not work. Now, so why is the economy growing? I kind of painted a gloomy picture from the supply side and real incomes and a lot else. But the economy is growing. That shows up in GDP. Why is it growing? The answer is fiscal policy, deficit spending. That's completely different than monetary policy. That works because, well, it works in the short run. It can be inflationary, but it works because when the government spends money, they're giving it to somebody. The money that the Fed created, they give it to the banks give it back. End of story. The money that the Congress spends, the deficit spending, it's going somewhere. It's buying weapons. It's going to, food stamps or welfare or Medicare or Social Security checks or, the Green New Scam or, a lot of it's kind of wasted, but it's going out into the economy. People are getting paid. Corporations are getting paid. They're paying their workers. That money actually does create growth. Now, but there's another problem associated with that. So the short answer is monetary policy doesn't work. It's a joke. We follow it, we report on it, but I'll tell you as an analyst, it's a joke.